This is a topic that when I address it, I always ask myself, where do the people who I'm meeting with, where do they fit into the whole idea of a bear market? What does it mean to them? What does it mean to a first-time investor? What does it mean to a retiree? What does it mean to a person who was about to retire and all of a sudden they've seen their portfolio fall in value? So as I go through it today, my orientation is going to be towards older investors, people either close to or in retirement. And I'll finish this discussion about the bear market focused on distributions. I'll touch on it. As I talked with Jim before we got started, I asked him in the survey that you fill out if you might be able to make a comment about how you would feel about a presentation that's all about distributions, that really digs into all of the fine points of how to get the most out of our money in retirement and how much risk we should take. But I'll touch on those things today, but I can only dig so deep when I've got an hour. So how to invest in a bear market. And I want to also pull my pen up here, if you'll let me. Okay. Well, probably the most famous person that I know in our industry is Warren Buffett. And when we talk about bear markets, what we're thinking about is we're thinking about losing money. And we know, if you know Warren Buffett's quotes, that his most famous quote is, rule number one, never lose money. Rule number two, never forget rule number one. So here is this suggestion that losing money is a bad thing to have happen. On the other hand, that is not what Warren Buffett had on his mind, a bear market. What he had on his mind is the long term. And the other quote that my favorite quote from him is, you only have to do a very few things right in your life, so long as you don't do too many things wrong. And one of the things he would tell you in a minute is that responding to or getting emotionally involved and afraid and defensive in a bear market, that is not the right thing to do. That is a mistake that so many people make that literally costs them half of the value of their portfolio. And he would remind us that bear markets, those losses are temporary. Well, they are if you're broadly diversified. If you're in the Enron bear market, it was not a temporary bear market, it was permanent. But when you're diversified and investing in a prudent way, bear market losses are temporary. And I'll talk about those in just a few minutes. The things that he would be concerned about, and I am concerned about, is the bad decision that leads to a permanent bear market. Remember, a bear market is a loss of 20%. That's from the peak. And so when I think of a permanent bear market, it's anything that takes money out of your pocket to be gone forever. When I was first a broker back in the mid-60s, 1960s, the loads on a mutual fund were 8.5%. I mean, you immediately, when you put $10,000 to work, $850 is off working for somebody else for the next 200 years. Now you say, well, 200 years, that's a silly thing to think in terms of. No, I think it's okay if you're thinking about your life and the family after you. So there are bad decisions that don't even seem like they are anything to do with the bear market, except they are likely to lead to 20% underperformance. When you could have had $1 million, you ended up with 800,000. And it's because of something you did that caused that bear market to happen. And of course, the good news is that with good decisions, you can eliminate those permanent bear markets. So some of the permanent bear markets, anything that costs you 0.5%. Now, this would be aimed at somebody who is either just starting to invest and they're in the accumulation phase of their life, but it would also have to do with somebody just coming into retirement who's about to go into the distribution stage of their life. In either case, 0.5% more, or if you want to look at it less, return is going to be a 20% difference in what you're likely to have over a lifetime. Remember that over a lifetime is about two things. One, of course, it's you get to retirement, you got a pot of gold there, and you're going to live off that pot of gold. That pot of gold is not gold until the day you actually take it out and spend it. Up until that day, we would consider that to be blue sky because you don't know what it will be worth in the future. So the real return from your investments is what you take out in retirement. And then there's that whatever you got left over when you pass on. And that is part of what you earn. Now, others will then have to decide what to do with it after that, but that is the part that you can actually take credit for. So what are some of the very specific ways that we can do something to cause a permanent bear market? One is in mutual funds, paying higher expenses than you should. It's easy to save 0.5% there. It's paying too much in taxes. It's easy to control the taxes that you pay if you invest in the right way. So owning an actively managed fund actually normally means paying higher expenses, paying more in taxes, and also paying more in just the way that the shares of stocks are traded in and out of the market. Active management has historically cost investors somewhere between 0.5% and 2% a year just because of the higher expenses and the higher activity. Putting too much in bonds. See, every time you add 10% of your portfolio to bonds, it will reduce the long-term return by about 0.5%. So if you put too much in bonds, and you had the risk tolerance to have more equities in the portfolio, that's going to create a kind of a permanent bear market. Taking too much out in retirement. You could, following a big bull market, think that you could afford to take out 5% a year. It felt so easy after the 90s that a person could count on getting high rates of return. Well, the 90s were followed by a 10-year period that the S&P 500 lost money on a compounded basis. So too much in bonds can in fact hurt you. Too little in bonds can actually hurt you. Taking too much out in retirement can hurt you. And of course, panicking in March of 2008 or January or February. I'm sorry, that was 2009 was when the market turned and just skyrocketed. And in fact, you were at the beginning, and you didn't know it, you were at the beginning of one of the greatest bull markets of all time. And there was nothing that would have led us to believe that that was what was going to happen. And then for young people, this is not a problem for people who are older generally, but young people, there's still this belief that I can get in there and trade in and out of the market and I can do better. There is not 1 ounce of evidence that there are probabilities you're going to do better by trading the market than simply buying and holding a low-cost index fund. Oop. There we go. So quickly, what we know about bear markets. Even though they're temporary, they're scary. There's no question. And sometimes they happen too often. We know that going back to 1929, there have been 26 bear markets, one every 3.5 years. That's pretty scary to think that you're going to have to to live through a 20% plus decline with an average loss of 35%, a third of what you have worked so hard to accumulate. Once every 3.5 years, you're likely to lose, and on average, they're going to last for 10 months. Well, of course, the word average can be very misleading. We do know the worst period that we ever had in terms of bear markets was from 29 to 1938. There were 9 bear markets in that 10-year period. The average loss was 42.5%. The biggest decline was 61%, but the average length was only 6.5 months. So it was a terrible time. I might tell you that while a lump sum investment at the beginning of that period would have left you with a loss at the end of that period, on the other hand, if you were dollar cost averaging in like we want our kids and our grandkids to do, you actually would have made about a 10% a year return during that same terrible period for buy and hold lump sum investors. And at the other end of the spectrum, if there are some periods that where bear markets happen more often, it won't shock you to find out that there was a period from 1982 until 2000 that there was only one bear market. And it was a short one, lasted for about 3.5 months. And it was about that same time that investors also from 1975 to 1999 had over a 17% compound rate of return. And boy, did we think we were smart. Well, what we were was we were very lucky to live through one of the longest and best bull markets ever. So what happens now? What happens in terms of dealing with the bear market needs to start with what equities we are in, what asset classes we are in, because that is going to have an impact on how much you lose. Some asset classes have a history of losing more in the bad times and making more in the good times. Others make less in the good times and lose less in the bad times. And those are choices that you have. It doesn't mean that the future will look like the past, but at least we know that about these in the past. Now, when I came into the industry in the mid-60s, they sent me, the firm I went to work for, sent me to New York to go to the New York Institute of Finance, which sounded like a pretty highfalutin place, but what it was a sales training to become a broker. But they also taught you how they thought you should sell the idea of investing. And asset classes had nothing to do with what we were taught then. What we were taught then is that you should try to help investors have at least 10 to 20 stocks because that's a well-diversified portfolio. And they taught us that whether we told them what individual stocks to own, or if they put their money into a mutual fund, there would be a manager who would pick the very best companies. So it was all about picking stocks. Fast forward about 20 years from then, and the research out of the academic community convinced us, basically without much question, that it really wasn't about individual stock picking. In fact, it was almost just the opposite. What they wanted investors to do is to focus on asset classes. And here we have an asset class. LCB stands for large cap blend. Very large companies, typically recognized to be the S&P 500. So big companies, lower risk, higher quality, but if you historically put your money into large cap value companies, those companies that are out of favor, versus the large cap growth. Now, in the large cap balanced portfolio or asset class, it's a combination of growth and value. excitement, the industries of the future versus the kind of the bricks and mortar, the other kind of out of favor companies. And it turns out that not only are the large cap value companies more risky, they produce a better rate of return, 11.1% versus 9.9 over this 92-year period. But there's another asset class that the academics said produces an even better return, not because of magic, but because this particular asset class is more risky. It's small cap blend, small cap, value, and growth. And instead of 11.1 with the large cap value, it goes up to 12. But the gold ring, going back to 1928, is the asset class that they call small cap value. Small cap value gets a premium for being smaller companies because smaller companies are more risky than larger companies, and also picks up the premium from being the out of favor small companies rather than the really popular small companies. And that's what happened. The compound rate of return went from 9.9 from large growth and value to 13.2 with the small premium and the value premium. No magic, but it did take the academic community to dig this information out for investors, and it stuck. But what I like, and you'll see why in a few minutes here, is this 4-fund combo, 4 asset class combo. Some small cap value, some large cap value, some small cap blend, and some large cap blend. And that produced over that same period of time, 11.8% compound rate of return. Remember, I was hoping to find 0.5% more in the returns that you might get for the long term. Well, right here we go from 9.9 to 11.8. That is almost 4 0.5% advantages over time. But 92 years, number one, is a very long period of time. You might say, what does it mean? What do I learn from that? It's too long a period of time. Well, one thing we learned from it is that all of these asset classes lived with very large losses. The S&P 500 had a year it was down 43. Large cap value 61, small cap blend 48, small cap value 55. Every one of those asset classes can hurt the value of your portfolio a lot, which is why a lot of folks who are here today, including myself, don't have all of our money in the stock market. Our kids might wish we did because there'd be more growth. There'd be more money likely there at the end of our life. But in the meantime, we're not in the accumulation stage anymore. We're in the distribution stage. And typically, people are less aggressive. But if we look rather than at 1-year periods, let's look at 10-year periods. And hang on one second. I want to try to get rid of all these pictures over here. Well, that didn't work. Okay. I'm going to look at 10 decades, 10 periods, 9 periods of 10 years each. And every 10 years has a story. We know the story of the 30s, the 30 to 39 period, depression, high unemployment, lots of things that cause the market to have violent swings. Have you noticed there are a lot of people who say that the markets we're going through in some ways are similar to what people saw back in the 30s, a lot of volatility. What is interesting to me as we look at the best performer for that 10-year period, the best was long-term government bonds. T-bills were number 3. Where the heck did why would small cap blend actually produce a profit while the S&P lost money for that 10 years and small cap value and large cap value both lost quite a bit. Remember, value in difficult times tends to be a decline more than growth. In better times, the value tends to do better, as you'll see in a second. But what I can see over that 10-year period is the range from the best to the worst. And I can also see how the four-fund combo did here. That's important to me because I do think it is a very special strategy. When we look at the 40s and the 50s and the 60s and the 70s, we see that small cap value is the star performer. And the S&P 500, that we all know is one of the very difficult asset classes to beat, didn't do so well in the 30s, didn't do as well in the 50s, and didn't do as well in the 60s. And as a matter of fact, you'll notice the S&P 500 compounds at 7.8% for the 60s versus 14.3 for small cap value and 11.3 for the four-fund combo. Well, you can later, and I'm hoping that you will come back to some of these slides later and stop and take a look at this, because you will notice how little consistency there is one period to the next. Yes, small cap value, which is supposed to produce the highest returns over the long run, did in most cases. But there were, and by the way, bonds should normally be down here at the bottom. Well, large cap value was the bottom there, and in 2000 to 2009, the S&P 500 was at the bottom. So this gives us the returns with better perspective, but I want to even take it one step further. I want to look over 20-year periods. I'd like to see what I learn about the volatility, because from my viewpoint, this volatility I look at here is meaningful. I'd be lucky at 76 if I get another 20 years. But if I'm thinking about the equity part of my portfolio, I don't care if I've got 10% in equity or 30 or 50 as we do. That equity portfolio has, let's say, got to serve me well for the next 20 years. So I'm looking for, where am I likely to get the best return? Well, yes, small cap value, we would expect that. And we would expect small cap blend. But I can tell you, at my age, I certainly don't want to put all my money in small cap value or small cap blend. On the other hand, the four-fund combo, which has some small cap value, has some small cap blend, as well as having the large cap value and the large cap blend. Because it turns out that everything ended up the way that we expect. Small cap value, the compound rate of return for the whole period, 13.7, then down to 12.2, then 11.9 for the four-fund combo, then 11.1 for large cap value, and 9.8 for the S&P 500. So when I look at this table, if I had to place a bet between the four-fund combo or the S&P 500, I actually would feel like I'm going to have a higher probability with very little additional short-term risk, and in a sense, less long-term volatility when we look out 20 years. But it's obvious now when we talk about the bear market that, remember we said that value doesn't do well during a bear market, but coming out of the bear market, look at this, since 1926, 1 year from the bottom of a bear market, small cap value averages 70.7. 3 years out, 29.5. 5 years out, 25% a year compound rate of return. And by the way, I don't think people would complain about the S&P 500 coming out of those big bear markets. And by the way, the bigger the bear market, the bigger the typically the response is when the bull market comes back. There are two markets most of us here can remember. One is the 2002 bear market. That was from 2000 through 2002. And again, small cap value, 1 year, 42.2%, 3 years, 30.1%, and 5 years, 21.7%. So small cap value is the place to be. And by the way, it was the place to be from April of 2009. After 1 year, the small cap value up over 88%, 3 years, 29% a year, and 5 years, 27% a year. In all cases, substantially better than the more conservative large cap S&P 500. But the fact is, again, most of us are probably not going to feel comfortable deciding that that we want to be able to put our money in small cap value. And I got to get rid of this over here. There we go. Now what I want to do is I want to look at a table of numbers. Now here's an example where this table of numbers may be daunting, but the second time you look at it and the third time you look at it, it'll become very obvious. But let me give you the highlights. Here's the S&P 500, 1 year at a time from 1970. And on the next, we'll go all the way to 2019 on the next slide. So you can see year by year how you did. Well, there was a big bear market right there, 73, 74. That was probably the biggest bear market people had experienced since the last one during the Depression. Then for 15 years, you don't really see any bad returns. It was a great time to be invested in the stock market. Remember, I said earlier that from 1975 to 1999, the S&P 500 compounded at about 17+%. Over here, we have 100% bonds. So if I sat down with you when I was an advisor, I would know after speaking with you for a few minutes that you don't want to be 100% in bonds. You probably don't want to be 100% in stocks if you are close to or in retirement. So my job was to try to figure out where in between 100% bonds and 100% stocks would you be? So the hunt was for the right combination. We had to start out over here with some kind of equity position. This was the S&P 500 as the benchmark, but in this particular case, we're looking at the returns of the 4-fund combo. And on our website, and I'll show you where in just a few minutes, you'll be able to find many of these tables for you to sort through if you find it entertaining or you're actually looking for a better answer than what you have now. But every time we take some out of bonds and some out of stocks, it has an impact on the volatility. So for example, this is what my wife and I have, it's 50-50. And so we would know that when the big bear market of 73, 74 happened, the losses would have been big, but they wouldn't have been as gigantic as the losses of the S&P 500 without the bond portion. And if you wanted to take more risk, you took more losses. Just keep adding equities until you get up here where you're all equities, where that should be your maximum exposure to loss. Now, of course, that's the bad side. The other side of that coin is the likely gain. Now, when I say likely gain, I cannot tell you. In my case, if I lived 20 more years, I would have no idea where my returns would be on this table. I can tell you that over the 50-year period, the S&P 500 compounded at 10.6, and the 4-fund combo, the big small value growth, 12.3, and the 50-50, 10. Now, I might ask myself, how realistic is 10% as a long-term compound rate of return for a portfolio that's half in bonds and half in stocks? Well, I don't think it's very realistic. Why? Because bonds back in the 70s paid huge returns. In fact, even into the 80s. And now what do we see? We can see the bonds right over here from 2010 to 2019. The best year was an 8% return. When we go back for a second to the 70s, look at these bond returns. So let's look at here at the 80s. 6.4 followed by 9.6 followed by 25.7. Now these are short to intermediate term bonds. So they're going to be certainly more volatile than you would have in a money market account. But the point is, back in those years, you could get a huge return on bonds. But guess what else was huge? Yes, inflation. And in fact, in some cases, inflation was higher than these bond returns that we got back then. So what else do I like about this table? It talks about the losing periods. I can, for example, see here's at a 43.3% one-year loss for the S&P 500, a 47.3 for the four-fund combo, but over here it's a 25.5% one-year loss. That's what my wife and I expect could happen to us in the next 20 years. Now, we may get lucky and have a 20-year period that looks more like 2000 through 2019. Well, yes, there was a loss of 16.9 and there was a loss of 5, but nothing that came close to 25.5. So it's possible we won't have to face that music, but we will face losses that are going to be larger than if we had all of our money sitting over here in bonds, where the worst 12 months was a loss of 3.6. Something for you to look at later, but I want to walk you through it because I think you'll find it of interest. If you had a 50-50 strategy, I'm not advocating 50-50, I'm just saying, if you did have, using the S&P 500, using what we call the ultimate buy and hold worldwide portfolio, which is basically like the four-fund portfolio, but the four-fund portfolio is all U.S., and the ultimate buy and hold is U.S. and international. And by the way, the ultimate buy and hold does not mean it's the ultimate buy and hold for you. It is the best that I have been able to find. And so that ultimate is for a very small group of people. But it's still what we're all looking for. Each one of us is looking for our own personal ultimate combination. That's what we'd like to have if we could just know the future. But I'd like you to compare here, if you wish, not so much right now, but you can later compare year by year. How did the S&P 500 for 50% hold up compared to the four-fund combo? And what we can see at the very end down here is we can also compare the worst returns. And as I said before, there's not a whole lot of difference in terms of the worst 3 months, the worst 6 months, the worst 12 months. In fact, by the time you get out to the worst 60 months, there's 0.3% difference in that compound rate of return. So that table is the kind of comparison that I think individuals, if they really want to study this and get a sense of what they can trust. Now, this one's got to be daunting, but it is such a simple table, and it is so helpful, I think. It again assumes in retirement, what would have happened if you had been 50-50 stocks and bonds? What if you had invested $1 million in 1970? What if you used the S&P 500 as the equity portion of the 50-50. What if you had started taking out 3% a year in 1970? Plus, you would increase that distribution each year due to inflation, not hypothetical inflation, real inflation. How different did it look if you took out a 3% distribution or a 4% distribution or a 5% distribution? It's the same investment, 50-50 stocks and bonds, with the equity portion being the S&P 500. And using that fine-tuning table we looked at a few minutes ago, here's what I know. I can compare how much money I would have at the end of each 10-year period. Here for the $30,000 distribution as a starting point, I've got 1.3 million. I've got 1.14 million for the 40,000. Now, why would I have more money here in the 30,000? Well, it's because I took less out. And the more you take out, the more it's going to drain whatever you've got there. And in fact, by the time you look at the 5% distribution, you're down to $959,000. And there was a point at which you were down to $887,000 at the end of 1974. What does this tell me about taking out 5%? Sounds like it might be a little too aggressive. In fact, if I had the ability, if I could look forward into the future, which I didn't, and saw what happened here, you had nothing for the 95. From 95 through 2019, you were living with your kids. But if you took out 4%, you actually ended with some money at the end of the 50-year period. And this is interesting. Here at the end of 50 years, taking out 40,000 and increasing it with inflation. So you would have had enough to live on, theoretically. By the way, $40,000 was a lot of money in 1970 compared to today in terms of the buying power. But here's what you had: 2.7 million left over at the end of 50 years, taking out 40,000. You had almost $21 million left over, taking out 3% each year plus inflation. In other words, this is the balancing act that we've all got to figure out. Do I want to leave my kids, do I want to leave my son-in-law $20 million? Or do I want to leave them 2.7 if leaving them 2.7 means I get to spend more money? Well, those are all built in the hopes that it'll help people think through what kind of risk they take, how much they take out. And here is a comparison of that 50-50 again, but now we're going to show 50-50 S&P, 50-50 ultimate buy and hold, 50-50 four fund combo. So now we have three very distinct strategies. One has a whole bunch of different asset classes, but all US, and one has US and international. But since we talked about the S&P versus the four fund combo, let's notice one thing. First of all, we took out exactly the same amount from each of these investments because we started with 40,000 and we increased it every year by inflation. So there was nothing different between the three columns in terms of how much was taken out. What was different was how much was left in the end. The S&P, 2.7 million at the end of 50 years, and the four fund combo, almost 22 million. And that's because, and by the way, remember, this is a 50-50 strategy, not all equity. So it will show you, in essence, that's the advantage, believe it or not, of an additional 1%. Remember, the 4-fund combo made about 2% more approximately per year, thereabouts. By the time you put half the money in bonds, that reduces the return substantially. So these are huge decisions. And I want to show you one more way to take money out. And again, as I mentioned in the beginning, I am interested in finding out who would like to go through this slowly. Take an hour or two just to understand all of the implications having to do with distributions, far beyond what we're doing here. Anyway, if we look at a flexible distribution, and this is what my wife and I do in our retirement, we take out the beginning of each year 5% of the pool of money that is our retirement money. Has nothing to do with money that we're leaving to others. It is for our retirement. We hope there'll be some of that money left over, but we take out 5%. Now remember, 5% was very risky before. In fact, people ran out of money trying to take out 5%. But now, instead of taking out 5% and adjusting for inflation, what we're doing is we're taking out 5% of whatever the value of the portfolio is at the first of each year. And so that's what we have to spend that year. And if the market goes up, we get a raise the next year. And if the market goes down, we get a cut in pay the next year. But doing that defensive thing, adjusting your distribution based on the direction of the market, has a huge impact over time, because instead of running out of money, remember before there was nothing over here in this 5%, it was blank. Here we got money, the distribution going every year, the final distribution 257,000, and it had 5.8 million left over. What was the difference? In the first one, we forced a 5% fixed distribution plus inflation. Here, we simply took that 5% of the value of the portfolio once a year. And you can see the returns if you took out 30,000 initially, 3%, and simply take out 3% of that balance each year. And you'll notice there is a ton of money left over for heirs. And you defend against the worst of times anyway, for a longer discussion for those who are interested. And finally, one last look at the flexible. Here's the result down here, lower right. If you use the flexible and you use the S&P 500, at the end of the 50 years, you would have taken distributions, total distributions of what would be left over at the end of the 50 years was 9.8 million, and you would have taken 9.1 million out. With the 4-fund strategy, you would have had a year-end value of 14.9, and you would have taken out $13.3 million. Again, a vote from me on the 4-fund combo. And I know for many, it probably sounds like something for young people, but in fact, it is a kind of a strategy that could represent a portion of a retiree's portfolio. And I'm not trying to sell anybody in order to line my own pocket. I am simply exposing what I have learned from others. For people who are earlier in the retirement process, it's easy how you can retire earlier. One is you can get lucky and happen to be investing during a period of time that doesn't matter how much you know about investing. They're just like bending over and picking up money. There are periods like that. But I think for people who want to try to control the outcome, you save more, you save earlier, you reduce your cost of living. A lot of young people today reducing their cost of living where they're saving 50, 60, even 70% of their earnings. The purpose, to be able to, in essence, live on their own, doing what they want to do to help others. It's not because they want to retire and be on the beach at age 40. They want to quit working for others and have enough they could retire and do what they wish to do. I actually am a member of that group, except I waited until I was 70. And so I was able then to do what I wanted to do, and that is to teach about investing. And so it applies to all ages, I think. Adding equities to the portfolio, that's pretty obvious. Every 10% more should increase your return by about 0.5%. Increase the diversification of the equities. Studies show that more diversification leads to higher returns, not lower. Reduce mutual fund expenses, that's a gimme. Reduce taxes, another gimme. Invest in index funds, the best way I know to lower taxes, to get more diversification, to lower expenses, to get a return you can count on, not hope for. And invest regularly and buy and hold, which means do not market time. These are all articles. These are live links. You would be able to go to the ultimate buy and hold strategy. There's a whole page on my website about buy and hold. There's a page about fine tuning. That page includes maybe a video, maybe an article, and a podcast, and lots of tables. The same thing with distributions, for contributions, target date funds, small cap value, and that's the gold ring. And for those that want to do something for a grandchild, please check out how to turn $3,000 into 50 million. It's not a con game. It's real. And I hope you enjoy it, and I hope you do something about it. If you have questions, you know where to write to me, paul@paulmerriman.com. This is our website. Free books. These are simply written short books, about 100 pages, I think, each, and helpful, typically more so to early investors. And then if you want to sign up for our twice a month newsletter, you can sign up right here. And by the way, for everybody who has signed up, when we come out with our new book, we have a new book that will be out hopefully by September. We will automatically send you a free copy of that new book. So that book, by the way, is about $12 million decisions guaranteed to change your financial future. And also the last half of the book is about 2 funds for life strategy, a terrific strategy for young investors.